Welcome to the SmartKeys podcast. Imagine, just for a second, looking at your team's calendar for the year and magically finding a way to get 35,000 human hours back.
I mean, that is a staggering number to even visualize.
It really is, just handed right back to you. I want you to really sit with that number for a moment. Think about, the human toll of 35,000 hours spent on soul-crushing manual data entry.
Yeah, the repetitive copying and pasting.
Exactly. What would your team even do if you could reclaim that time and dedicate it to actual creative problem solving?
That sounds like science fiction, honestly.
Right. Or maybe some overly aggressive marketing pitch, but it's actually happening in the market right now. Today, we are bringing you into a conversation between insiders about the absolute bleeding edge of the future of work.
And it is a future that is arriving much, much faster than most organizations realize.
Yeah.
Those 35,000 hours, they aren't theoretical. They are a direct, measured result of restructuring how we handle financial data. We are moving away from brute force human effort and moving toward elegant systems.
And our mission for this deep dive is to extract the most critical strategic insights from a really comprehensive guide we've been immersing ourselves in.
Right, the Felix Römer piece.
Yes. It's by Felix Römer from SmartKeys.org, titled Finance Automation Trends, Streamlining Business Accounting. We're going to mine these insights to give you, the modern professional, a blueprint to stay ahead of the curve.
Because you really have to frame the current business landscape for a moment to understand why this matters.
Definitely. There's this staggering data point from Deloitte and the IMA that really sets the stage here. They found that 65% of finance respondents say their controllership is unprepared or, only somewhat prepared for future demands.
Which is, that statistic should be a massive wake-up call.
Right.
We have a majority of the industry openly admitting they're standing on the beach watching a tsunami roll in.
Yeah.
And they know they don't have higher ground to retreat to.
It's terrifying when you put it like that.
But it's true. We are transitioning into an era of unprecedented information density. The old ways of managing ledgers, they simply cannot scale to meet the volume of data hitting servers every single day.
So we aren't just talking about saving a few clicks here or finding a better keyboard shortcut.
No, not at all.
We are talking about surviving a coming wave of information overload that threatens to absolutely drown traditional accounting and finance teams.
Exactly.
So to fix this lack of preparedness, to build that higher ground you mentioned, we first need to define the actual tools that are reshaping the landscape. Okay, let's unpack this because the jargon in this space can get incredibly dense.
Oh, it's an absolute alphabet soup.
It really is. You hear acronyms thrown around like confetti. So let's start with two of the big ones, BPA and RPA.
Right. Business process automation and robotic process automation.
Yeah.
They often get lumped together in vendor pitches, which is frustrating because they serve fundamentally different structural purposes in a business.
I actually like to think of it with a 5-volt analogy.
Oh, I love a good analogy. Lay it on me.
Okay, so think of business process automation, or BPA, as the overarching highway system of a business. It's the grand infrastructure.
Okay, I'm with you.
It handles system-wide orchestrations. Think about how your company processes payroll across multiple departments, or how it routes massive vendor payments through different approval tiers.
A whole end-to-end flow.
Exactly.
Sure.
Or the entire onboarding pipeline for a new client. It's the concrete, the lanes, the on-ramps. But robotic process automation, RPA, those are the specific delivery trucks driving on that highway.
That visual mapping is incredibly helpful, actually, because you don't use a massive infrastructure project to deliver a single package.
Right, you just send a truck.
Exactly. And you don't use BPA to perform a single repetitive data entry task. You deploy an RPA bot.
So the bot is the truck.
Yes. These are discrete software programs that exist simply to do things like log into a portal, download a CSV file, format it, and send out a batch of invoices at 5 p.m. every day.
Just mimicking human keystrokes for highly repeatable tasks.
Exactly. It's the delivery truck doing the exact same route over and over, never getting tired, never needing a coffee break.
But as I understand it, those standard delivery trucks have a pretty severe limitation, don't they?
Yeah, they do. They are completely blind.
Oh, wow. Blind how?
Well, standard RPA bots only know how to follow a highly specific, rigid set of coded rules. If a roadblock appears, say, a vendor suddenly changes the format of their invoice, right?
Mm-hmm.
And the date field moves from the top left corner to the bottom right. The standard bot doesn't know what to do.
It just panics.
Basically.
Mm-hmm.
It crashes or it throws an error, and it sits there waiting for a human being to come fix the broken logic.
So the truck hits a detour sign and just turns off its engine.
That's exactly it. And what's fascinating here is what happens when you introduce the next layer, intelligent automation.
Okay, adding AI to the mix.
Right. This brings artificial intelligence and machine learning into the fold, and it changes the paradigm entirely. It is no longer about blindly following rules.
So what is it doing instead?
It is about utilizing adaptive models that can actually learn from historical data.
Okay, but how does that actually work in practice? Like, how does a piece of software learn from an invoice?
Let's use that some invoice example. When an intelligent automation system encounters that new invoice format where the date has moved, it doesn't just crash.
Right.
It looks at the surrounding context. It recognizes the word date, or it identifies the standard format of a month, day, and year. It makes a probabilistic guess.
Oh, so it tries to figure it out on its own.
Yes, and if a human operator later confirms that guess was correct, the machine learning model updates its own internal rules.
That's wild.
So the next time it sees that weird format, it processes it flawlessly. Over time, these systems refine their classifications, they recognize complex patterns in unstructured data, and critically, they reduce false positives.
So the system learns how to navigate the detour all by itself.
Exactly. It's the difference between a toy car on a plastic track and a self-driving vehicle that can navigate traffic.
Okay, so now that we know what these tools actually are, the obvious question is, what happens when they hit the real world? Why should you or your business actually care about this alphabet soup of technology?
You care because of the profound impact on the bottom line and the exponential increase in operational velocity.
Right. The actual ROI.
Yes. Felix Römer's research provides some heavy-hitting case studies that move this entirely out of the realm of theory and into measurable reality.
Let's talk about those, because they honestly blew my mind. Remember those 35,000 hours I mentioned at the start?
I do.
That was IBM. They applied these automation tools to their pricing decisions.
And pricing for a company the size of IBM is mind-bogglingly complex.
I can't even imagine.
Before automation, human analysts were manually gathering competitor data across different regions, calculating historical margins in spreadsheets.
There's a spreadsheet.
And painstakingly entering those figures into internal systems to generate a competitive bid. It was a massive bottleneck.
Right.
By automating the data collection, calculation, and entry tasks, they entirely removed that manual friction.
And if you do the math on 35,000 hours, assuming a standard 2,000-hour work year, that is essentially the labor output of over 17 full-time employees.
That's a huge shift in resources.
It is. 17 people doing nothing but moving data from one column to another, entirely reallocated to actual strategic analysis.
And perhaps more importantly for their revenue generation, it trimmed their bid cycle time by 75%.
Wow, 75%.
Yeah, they win more deals because they can quote a complex project faster than the competition. Speed becomes a competitive moat.
It's an incredible advantage. And we see the same dynamic in the financial sector too, right?
Absolutely. TD Ameritrade used IBM Cloud Pak to completely overhaul their client onboarding.
Okay, how did that work?
Historically, opening a new brokerage account required human compliance officers to manually check fields, verify identities against databases, and cross-reference forms.
Very high-friction process.
Exactly. But by replacing those manual checks with automated rules and field validations, the time it took to open a new account dropped by 70%.
That is a direct, immediate upgrade to the customer experience. You're not waiting days to start trading.
There you go.
But I love that this isn't just restricted to massive tech conglomerates and banks. The research points out how this applies to the hospitality sector, too.
Oh, the Primanti Brothers example.
Yes. The restaurant chain. They deployed a simple RPA bot, one of those delivery trucks we talked about, just to handle their daily sales and labor reports.
The mechanism there is incredibly practical. Instead of a restaurant general manager staying late to log into the point-of-sale system, pull the daily receipts, calculate the labor hours, format an Excel spreadsheet, and then email it to corporate.
Which is just brutal after a long shift.
It really is. But
Yeah.
now the bot does it. At 3 a.m., the bot wakes up, scrapes the POS data, structures a report, and has it sitting in the regional manager's inbox before they even wake up.
That is brilliant.
That single targeted deployment saved them 2,000 hours and $84,000 annually.
And then you have Virgin Money using an AI assistant named Ready. It's equipped with natural language understanding to resolve customer account issues in real time.
Right.
I want to pause on that term, natural language understanding, or NLU. How does that differ from those awful clunky chatbots we've all fought with on customer service websites?
You mean the ones where you're just screaming representative into the keyboard?
Exactly. Those are terrible.
Well, older chatbots use simple keyword recognition. If you type lost card, it triggers a pre-written script about lost cards.
Right.
But if you type, I think I left my wallet in an Uber, a keyword bot gets completely confused.
Because the word card isn't there.
Right. NLU, on the other hand, understands the intent behind the messy, colloquial way humans actually speak.
Oh, so it reads between the lines.
Exactly. It deduces that left wallet in Uber means lost card protocol needs to be initiated, and it can execute that freeze autonomously, drastically lowering call center volumes.
Okay, I have to play devil's advocate here because I am genuinely curious.
Go for it.
I've lived through corporate software implementations. They're usually nightmares that drag on for years and go wildly over budget.
Yeah, they can be.
So if the results are this incredible, saving millions, cutting cycle times by 75%, why isn't every single business doing this perfectly right now? Where is the catch?
The friction lies in the implementation gap. Remember that Deloitte and IMA statistic about 65% of teams being unprepared.
Yeah, standing on the beach.
Right. The primary barriers cited aren't a lack of desire or a lack of budget. They are a lack of time and a critical lack of implementation expertise.
So they just don't have the bandwidth.
Teams are so overwhelmed by the daily grind of manual work that they literally cannot pause long enough to build the automated systems that would save them.
They are sprinting on a treadmill just to stay in place so they can't step off to upgrade the machine?
That is exactly it. And beyond the time constraint, there is a massive strategic hurdle. Businesses fail to properly quantify the value of the integration effort.
How do you...
Well, to get buy-in from leadership, to endure an implementation, you have to link that saved time to real hard dollars. You can't just walk into a board meeting and say, hey, this bot will save us 20 hours a week.
Right, because leadership will just say, great, so what?
Exactly. You have to calculate the fully loaded labor rates.
And let's define fully loaded labor rates for anyone who isn't a financial controller.
A fully loaded rate is the true cost of an employee. It is not just their hourly salary.
Right, it's everything else.
It includes their health insurance, their 401k match, the payroll taxes the company pays, the software licenses they use, and even the physical office space they occupy.
It adds up fast.
It does. When you calculate the value of an hour saved using that number, the financial return suddenly becomes much more compelling.
You really have to speak the language of the CFO to get these projects greenlit.
Furthermore, you must calculate the net present value, or NPV, of the automation project.
Okay, NTV.
This means looking at the total cost of building the bot today versus the cash value of the hours it will save over the next 3 to 5 years, adjusted for the time value of money.
Oh, so bringing future savings into today's dollars.
Yes. Without that rigorous mathematical measurement, an automation project just looks like an expensive IT experiment rather than a fundamental shift in operating leverage.
Okay, let's say you do the math, you speak the CFO's language, you get the buy-in, and you start automating. You are now handing over processes that manage millions of dollars, process sensitive banking data, and manage corporate payroll to algorithms.
Yeah, it's a big step.
Here's where it gets really interesting to me. My instinct is that giving computers the keys to the financial kingdom introduces massive risk. How do we make sure the software doesn't execute a disastrous company-ending mistake at the speed of light?
That is the ultimate governance question.
Yeah.
And surprisingly, the data shows that good, deep integrations actually increase safety and security.
Wait, they increase it? How?
They achieve this by eliminating what we call the swivel chair problem.
The swivel chair problem. Walk me through what that actually looks like on the floor of an accounting department.
Picture a junior accountant working at a desk with 2 monitors. On the left monitor, they have an invoice open in an email. On the right monitor, they have the company's ledger software.
Okay, I see it.
They literally swivel their head or their chair to read a number on screen A and then manually type it into screen B. That human gap, that physical transition of data through a human brain and fingertips, is where the typos happen. It's where the transposed numbers happen. It's where the million-dollar decimal errors occur.
Wow. So the danger isn't the machine. The danger is the gap between the machines. By removing the human swivel, you lock down the data integrity.
Exactly. Felix Römer highlights Stripe as a prime example of doing this correctly. Stripe uses real-time automated data pipelines connecting their ERP systems, their customer relationship management tools, and their banking partners.
So no one is copy-pasting anything.
No. Because the data flows through a seamless encrypted pipeline without human interference, the resulting financial reports remain strictly auditable and perfectly compliant with regulators.
If we connect this to the bigger picture, how does a company actually build that seamless pipeline? You mentioned earlier that it's not just plugging a cable from one app to another.
Right. It requires architecting what is known as a hub-and-spoke model.
Hub and spoke.
Think of your central accounting ledger, your ERP as the brain or the hub. Your CRM, your payroll system, and your inventory operations are the spokes.
Okay, that makes sense.
The integration ensures that every spoke speaks the exact same standardized data language before it feeds into the central hub. It is a fundamental engineering effort.
And once you build that hub, what are the guardrails? How do you keep it locked down?
There are a few non-negotiable controls. First, you need end-to-end encryption to protect the data while it is moving between the spokes and the hub.
Right, standard security stuff.
Second, you implement strict role-based access. This means a software bot, just like a human employee, is only granted the exact minimal permissions required to perform its specific task and nothing more.
So the invoice bot can't suddenly access payroll.
Exactly. It deters internal fraud and limits the blast radius if a system is compromised. And crucially, you must have incident runbooks established.
Incident runbooks. I've heard that phrase tossed around in engineering circles. What does it actually mean for a finance team?
A runbook is essentially your emergency parachute instructions. It is a highly documented, pre-planned set of steps for investigation and rollback the moment an anomaly is detected.
Oh, so if things go wrong, you're not just guessing.
Right. If a bot starts classifying expenses incorrectly, you don't want your team frantically figuring out how to unplug the server. The runbook dictates exactly who gets alerted, how to pause the automated flow, and how to revert the ledger to its previous state.
That's incredibly smart.
We see this level of control in institutions like PNC Bank, which leverages tools like IBM Sterling to use validated transfers. This ensures that when data moves between entirely different partners and entities, the exchange is mathematically verified and inherently secure.
So good controls make faster processing safe.
Exactly.
So with the foundation laid, the hub and spoke architecture built, and the runbooks written, what is the next frontier? Where is the future of work actually heading?
We're witnessing a monumental shift toward what is being called agentic AI.
Agentic AI. Let's really break that down, because the term AI gets used to describe everything from a spam filter to a chess computer. We are moving from AI assistants to AI agents. What is the mechanical difference?
The distinction really comes down to autonomy and task complexity.
Okay.
An AI assistant is reactive. It waits for your prompt. You ask it to summarize a PDF or draft an email, and it does that single task and stops.
Right.
An AI agent operates proactively within a set of parameters. It is designed to plan complex tasks and execute multi-step operations.
So instead of just reading a novel for me, it's figuring out how to write the next chapter.
That's an excellent way to conceptualize it.
Yeah.
In a finance context, an agentic AI system doesn't just pull the numbers for a monthly reconciliation.
It does more.
It runs the reconciliation, identifies a discrepancy, drafts an email to the vendor asking for clarification, and flags the unresolved variance for a human manager to review.
Wow.
It is performing the variance analysis, not just summarizing it.
So what does this all mean? If I'm a professional sitting here listening to this, and an AI agent is going to be doing the variance analysis, reconciling the cash flows, and drafting the budget, what exactly am I supposed to be doing? Do I just pack up my desk?
Well, this raises an important question, right? And it's a very real anxiety that many professionals share. But the trajectory of the technology suggests the human role does not disappear at all.
Okay, good. So what happens?
It elevates. When the machine takes over the mechanical compilation and basic analysis of data, human capital must shift toward higher-order work.
It shifts from the tedious data gathering to the actual data interpretation.
Exactly. The new core competencies for the modern professional fundamentally change. The first is prompt design.
Meaning?
Knowing exactly how to instruct, constrain, and query these AI models to get the right analytical outputs. The second is exception handling.
Right, because the bots aren't perfect.
AI agents are great at patterns, but they struggle with ambiguity. When the AI flags a complex edge case that requires human empathy or deep institutional context, the human steps in.
That makes sense.
And the third is policy oversight. Managing the model's lifecycle, tracking data drift to ensure the AI hasn't developed bad habits, and ensuring the automated outputs align with the broader strategic goals of the business.
So you move from being the person operating the machinery to being the architect overseeing the entire automated factory. You upgrade from the person swinging the hammer to the general contractor directing the build. That makes perfect sense. So how can someone listening to this deep dive right now actually begin this transition tomorrow? How do they avoid the nightmare implementation and actually get a win?
The research emphasizes a highly pragmatic, phased roadmap. Step 1 is simply mapping your current pain points.
Not buying software.
Do not buy software first.
Yeah.
Sit down and build a current state map of how work actually flows through your department today. Figure out exactly who owns what task and identify exactly where that swivel chair data entry is happening.
And step 2, from that map, you pick a very specific, isolated target. You are looking for a process that is high volume and high touch.
Yes, you want to target something painful like accounts payable, invoicing, or the month-end close. You need a clear win that touches all the dollars and consumes a vast amount of manual hours.
Right.
And then, step 3, you do not rip and replace your whole ERP system. You run a short, tightly controlled phased pilot on that single process.
You prove it in miniature before you roll it out to the enterprise.
Exactly. And critically, you must establish baseline key performance indicators, or KPIs, before you begin the pilot.
You have to know where you started.
You need to document your current error rate and your current cycle time. That way, when the pilot finishes, you can mathematically prove the value of the automation to leadership.
Bring out the ROI.
Once the pilot validates the time savings and the error reduction, then you secure the budget to scale it.
It all comes back to being intentional and proving the ROI mathematically. We've covered a massive amount of ground today, from the infrastructure highways of BPA to the tireless delivery trucks of RPA, the staggering returns achieved by IBM and Primanti Brothers, the critical security of removing the swivel chair, and the horizon of agentic AI.
It really represents a profound, irreversible shift in how a business operates its most vital nervous system, its financial data.
It really is an operational revolution. And I want to leave you with one final provocative thought to mull over as you look at your own workflows this week. As these AI agents increasingly take over the heavy lifting of gathering, matching, and reconciling endless rows of data, the most valuable skill for a modern professional won't be your ability to quickly crunch the numbers.
No, the algorithms will crunch the numbers instantly.
Right. Your ultimate value will be having the critical strategic thinking to question the logic behind the numbers, to ask why the data looks the way it does, and to decide what the business should actually do about it.
The automation systems will reliably handle the what. The human mind must step up to provide the so what.
And what will you do with those 35,000 hours? We want to explicitly thank you for tuning in to the SmartKeys podcast today. If you found this conversation valuable and want to stay ahead of the curve, please hit that subscribe button to never miss a deep dive into the insights that matter most. And we highly, highly encourage you to read Felix Römer's full article. We've barely scratched the surface here. His piece contains complete implementation templates, a briefing framework for leadership, and so much more technical detail. You can find the link right there in the show notes. Until next time, keep thinking critically about the tools that shape your work.